Welcome to the Vaughan Nelson podcast. With me today is CEO and CIO Chris Wallis. Welcome, Chris.
It's great to be here, Dan.
All right, Chris. Well, it's been a couple weeks in a pretty slow news cycle out there. But maybe one thing that folks would be curious about, since the last time we spoke, is looking at the recent bankruptcies of both First Brands and Tricolor. They've really highlighted the potential risks out there in the private credit world. Do you have a view on what is happening and what could potentially be next out there?
Yeah, as we've been describing it, we thought that economic activity could improve in the back half of the year, but one thing that was going to work against it was just the maturing of the credit cycle. And so, the bankruptcies of First Brand and Tricolor, or that there's been a lot of loan modifications and extensions and delays of workouts and troubled assets for the last couple of years. And, to a certain extent, you're just getting to the end of the line. You can't kick the can down the road anymore. So losses start showing up. Inevitably, when we've been through such a period of easy money, easy access, and low cost, and we saw a massive growth in private credit with non-deposit financial institutions, you're going to get abuses in that area. And so we saw collateral being abused in the case of First Brands and Tricolor. Interestingly enough, we've seen the same issues in commercial real estate and elsewhere where people thought they were first lien. They went to seize assets, realized they weren't first lien. There were people ahead of them. And so we're in the early stages of the beginning of the downside of the credit cycle. At this stage, I don't think it's significant enough to derail the equity rally. If anything, it's going to give more reasons to lower rates even further. But I do expect there's going to be a lot of problems out there. We created through ETFs and just through increased access to private credit, a lot of money that had to get put to work. I think we're going to find a lot of people didn't do the due diligence necessary to ensure that that fraud wouldn't occur or other negative outcomes wouldn't occur. And so, if you're a risk manager and you've seen these losses occur, you're going back and starting to check within your ABS securities whether your collateral is good. You're probably slowing down new loans, and all of those things tighten up credit. And so I certainly expect we're going to see more losses. I think we're going to see more in the case of First Brands and Tricolor in and around auto supply chain. I think we're going to see more there for sure, but we're going to see them branch out. We're going to start to see losses occur. And this is going to be a normal part of the refi cycle that kicks off this year and will run for the next couple of years. And that's going to, again, just kind of tighten up credit conditions for those the riskiest of borrowers. We've already seen it bleed out into the consumer. We've seen this because in addition to factoring, we've seen losses accelerate in subprime auto lending. So we've seen lenders pull back. So, everybody's been anticipating a recovery in auto sales. The reality is, I think we're going to have another down year. There's just not going to be enough financing. In a lot of cases where loans have been modified and payments still aren't being made, lenders are not going through the foreclosure process to repossess cars. And the reason they're not doing that is because the collateral value is insufficient and they can't recognize the losses. So there's a lot of extend and pretend in auto lending as well. And those losses are slowly going to come to fruition over the next kind of 12 months or so. And what we've seen out of the buy now, pay later is these are the most stressed consumers. And when we changed kind of rules in credit reporting, I believe it was at the end of September, and we started reporting missed student loan payments, missed healthcare payments. People that had high FICO scores or higher credit scores were immediately impacted and downgraded into subprime. So even if the money they borrowed was in a prime position in a securitization, the reality is they're actually subprime borrowers. So that means the buy now, pay later lenders have pulled back credit. So we're in the early stages of that negative reflexive element, and that's when you start to discover where the losses are, how big they are. And I think the market, for the most part, has done a good job of setting aside those companies that they know could be in financial distress. This is a bigger political issue, and the reason is, we're going to sit around, we're going to have 2% plus GDP growth in Q4. Inflation's going to be relatively modest. The S&P 500 is hitting all-time highs. And so, the wealthy, the asset owners in the country continue to do incredibly well. Their consumption patterns are holding up. Whereas those that are really struggling and needed access to credit to maintain and meet their monthly needs are under very severe distress, and it's only increasing. And the government shutdown is not going to help that as well at all. This is only going to feed more into kind of the populist politics that we've been living with the last several years. So the K-shaped economy is alive and well, with the low end clearly in recession, the high end not so much. And as we like to say, the worm's starting to turn on the credit side of capital markets.
And there's a few things I picked out as you're speaking there. You're talking about period of easy money, easy access, and then collateral begins to be abused. Talking about if you're a risk manager, you're going to go back, check on those ABS securities, right? See what your book looks like, and then also talking about the K-shaped economy. Well, the wealthy's holding up. Your consumption patterns for those wealthy are fairly stabilized. But you kind of think through the next step, and the second derivative of this is, this is going to lead to tightened policy. This is going to lead to tightened up procedures, which ultimately I would imagine is going to result in some type of a slowing market, right? So, how does this flow through, and what parts of the economy do you think would be most impaired as a result of this, what you describe as a negative reflexive momentum?
Look, I think the biggest issues are going to be with the institutional investors that have allocations into these areas, and with advisors that may have utilized credit ETFs in client portfolios, because I think there's, in a lot of cases where we've improved the ease of gaining access to these products, and you've seen a rush of money into those products, I think there's less agency and diligence with putting that money to work, because the incentive is to get it to work. And it was probably coming in faster than you could find opportunity sets. And so I think that's where a lot of the issues are going to be. The companies that are going to be stressed are already stressed, and so the market's already trading those at a discount. And we've seen that in the BDC space. We've seen that in the subprime space. So I don't have a lot of concern that people are going to be surprised where those issues are. So I think that's where it's going to play out to a large extent. Private equity will continue to be stressed. I don't think it's a surprise that there's a full court press with lobbyists to get the deregulation necessary so that they can offload paper into your 401k. So we're going to see that the stress that would have been concentrated in those institutional portfolios may get, quote, democratized to everybody. But I don't think this is going to be like a single event, kind of Lehman event kind of thing. And the reason I say that is you have a situation where the Fed's already provided backstop liquidity. There's plenty of liquidity available to post good collateral against. And so you shouldn't see the disruptions that kind of we were used to in the last downturn of a credit cycle. I just think it's going to be long and drawn out, and it'll take a couple of years to identify where all the bodies are buried.
Yeah. All right. Well, in a fairly slow, quiet couple weeks here, a little bit of interesting action. So glad we got to connect here, Chris, and we'll have you back here soon.
Sounds good.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.